Hi, welcome back to Westbury 101. I'm Brian Westbury, Chief Economist at First Trust Portfolios. Remember, we want to be the antidote to conventional wisdom. Well, right now, conventional wisdom says a double dip is underway. That's why the stock market's down. That's why the Congress and the president need to spend more for stimulus. That's why the Federal Reserve needs to cut interest rates or expand the size of its balance sheet or buy more treasuries. All of this activity, all of this worry right now around the economy is centering on this idea of a double dip and what we can do about it. And it's kind of all self-reinforcing. So the Federal Reserve buys into the fear of a double dip and says they'll buy more treasuries, and then analysts say, hey, look, the Federal Reserve is buying more treasuries and they're scared about the economy. That must mean there's a double dip. So literally these forces are self-reinforcing. And I want to tell you, I believe that we've overstated once again the risks to the economy, just like we did when we were first talking about Dubai. Do you remember that at the beginning of the year? For about a week, that was going to end the world. Greece and the pigs, Portugal, Ireland, Greece and Spain, the problems in Europe, remember that was going to end the world. Well, now it's the United States economy that's about to end the world. And I think in reality, all we've seen is a little bit of a soft patch in economic growth. Now, this may be real or it may not. Remember, this is a huge country, 300 million people. It's one of the largest continents in the world, and in the end, it's very difficult to measure. And statistical noise sometimes, I've seen this many times over my career, statistical noise can often make a quarter or a 2 or 3 month period look weak when it's not really. And then after the fact, down the road, 4, 5, 10 years from now, revisions will occur and we'll find out there really was never a soft patch. I think that's what we're likely to find out about this. And what's happened is with the market going down, 260 plus points on Wednesday, at least midday on Thursday, down another 50 points. We're down 3% in 2 days. These fears have just ramped up. Now, what's interesting is that I believe that overreaction to these fears and overreaction to the market dip and the soft patch is really what we should worry about. And let me talk about government stimulus. We wrote our Monday morning outlook this week and said, please, no more stimulus. And what we did is we compared the United States to Canada. What's fascinating is you go back from 1982 all the way through 2008. All right, so we're talking about a period of time of 26 years. The average unemployment rate in Canada was 2.8% higher than that of the United States. Now, lots of us supply-side economists used to point to Canada. See what happens when you have high taxes and big government and lots of regulation? You pay for that with higher unemployment and slower growth. And that's exactly what happened in Canada. But starting in the mid-1990s, Canada started reducing the size of its government. It was literally a sea change in the political environment in Canada. They've gone from 53% government spending of 53% of GDP down to 39% by 2007. Now, the G20, in the middle of the panic, in the middle of the crisis, the financial crisis of 08 and 09, forced, well, they can't force, but you get my point. They politically forced every country in the G20 to lift its spending, and Canada ran, and it is running, a budget deficit of roughly 4.5% of GDP. In the United States, we're running a deficit of 10% of GDP. So Paul Krugman, if you're listening, if you're a Keynesian, you should say the country that's running a 10% budget deficit literally should be growing faster than any country that's just running a measly 4.5% of GDP budget deficit. And in fact, the opposite is true. The Canadian economy is actually growing faster than the economy of the United States. The Canadian unemployment rate is now 8%, and it's been below the U.S. unemployment rate since October of 2008, since TARP by the way. So all of this activity, all of this stimulus by the United States has actually backfired and hurt our economy relative, in this case, to the Canadian economy and relative to what it would have been if we had not passed the stimulus. I believe that stimulus, in fact, is hurting us. At the same time, the Federal Reserve now this week announced that it's going to buy more Treasury bonds. It's going to take the principal that rolls off of mortgage-backed securities that as those mortgages are paid and buy Treasuries. And the reason that it's doing this is that it now is worried about the economy. The interesting thing about this is that this balance sheet that the Federal Reserve has, and now what they've said is we're just going to keep it steady at its current size, is not reflective of an easy monetary policy. We could spend all day on this, but the point that I want to get out here is that what really matters for monetary policy is the level of the federal funds rate and how much money the Federal Reserve is printing. They are printing new money. The federal funds rate should be closer to 1% to be a neutral rate. The size of the balance sheet, in my opinion, has little to do with monetary policy. So the Fed made some noise this week, but it really didn't change the long-term path of the economy. In the end, the Federal Reserve is still easy. Interest rates are below the natural rate where they should be. That's lifting growth. And then the second thing that I want people to remember or think about every time they look at the economy and get worried about the size of government is that even though government spending, if you take defense out of the budget, we are spending more than we ever have in the history of the United States. Even though government spending and redistribution have hit record levels, the economy is still growing. Technology is still driving new business models to record levels of profits. And the U.S. economy has created jobs in 7 months of this year, all 7 months, January through July. Also, when we look out into July and August and look at the data, retail sales will be reported on Friday. They're likely to be up more than 0.5% during the month after 2 straight months of decline. Auto sales not only did very well in July, but they're picking up in the first half of August. Industrial production in July should grow close to 1% for the month. And when you put all of this together, it looks like the soft patch is over. And I believe that any fears that have driven the stock market down today about whether it's the conservative side about stimulus or the liberal side about not enough stimulus, those fears are unwarranted like they have been so many times. In other words, I look for this market to turn around and head to new highs, at least for this move, after this correction runs its course. I don't think it will last that long. I think the soft patch is actually behind us. Take care, and we'll see you next time. Remember, we want to be the antidote to conventional wisdom. Done.
Okay.
All right.